When you hear the name Warren Buffett, you probably think market wizard, right? Someone with a crystal ball who just knows which way the stocks are going to go. But the truth is, he's not a wizard. He's an investor who built an absolute fortune by following a set of really clear, timeless, and honestly understandable principles. So let's pull back the curtain and see what they are. And it all starts right here. This single idea, it's the foundation for his entire philosophy. It's not about frantic trading or getting in and out fast. It's about a fundamental shift in your mindset, away from short-term guessing and towards long-term ownership. And that really sets the stage for everything else we're going to talk about. So the first big pillar is this mental shift. For Buffett, a stock is not just a ticker symbol flashing on a screen. It's a small piece of a real, living, breathing business. You have to start thinking like you're buying the whole company, not just some lottery ticket you hope goes up. And when you think like an owner, you start asking these really simple but powerful questions. You're not looking at charts, you're asking, okay, how does this place actually make money? What stops a competitor from coming in and crushing them? And, the big one, will people still be buying this stuff in 10, 20 years? It's all about genuine curiosity about the business itself. This quote just brilliantly nails the core of his analysis. See, the market price can swing like crazy based on fear one day and greed the next. But the actual intrinsic value of a good business, that's way more stable. The whole game is figuring out what a business is truly worth, and then having the patience to wait for the chance to buy it for less. What's fascinating, though, is that Buffett didn't always think this way. Early on, he was more of a bargain hunter, looking for just plain cheap stuff. But then, his partner, the legendary Charlie Munger, helped him see things differently. And this change, it was probably the single most important pivot in his entire career. The shift was subtle, but it was absolutely profound. He went from buying a fair company at a wonderful price, basically a so-so business that was super cheap, to buying a wonderful company at a fair price. Why the change? Because a wonderful company just keeps growing and making you wealthier over time. A mediocre business, no matter how cheap you buy it, is always going to be a struggle. Time is the friend of the wonderful business. Okay, so how do you find these wonderful businesses? Well, here's the secret. Buffett's genius isn't knowing everything about every industry out there. It's about knowing precisely what he doesn't know. He stays strictly within what he calls his circle of competence, just those few industries that he can understand inside and out. And that leads directly to this idea. This is his ultimate form of risk management. It's got nothing to do with fancy hedging strategies or complex financial instruments. Risk, for him, is simply betting on games you don't understand. Sticking to what you know isn't limiting. It's your greatest protection against making a huge mistake. But here's the thing. Finding a great company that you understand, that's only half the battle. The other half, and you could argue it's the harder half, is mastering your own behavior. And that brings us to the next pillar, letting patience and discipline become your ultimate edge in the market. The first rule of this discipline is to always, always demand a margin of safety. It's a simple concept, really. Even when you're sure you're right, you act as if you might be wrong. So once you've figured out what a business is truly worth, you insist on buying it for a whole lot less. That buffer, it's like the suspension on a car, protecting you from bad roads, bad luck, or just you being wrong. And if margin of safety sounds a little too technical, he has this beautifully simple way of explaining it. It's just common sense, right? You wouldn't pay full price for your favorite pair of socks if you knew they were going on sale next week. So why would stocks be any different? You find a high-quality business and you wait for it to get marked down. Now, if you want to understand the true mind-bending power of patience, just look at this number. It's staggering. Around 90% of Warren Buffett's wealth was built after his 60th birthday. No, that is not a typo. That is the almost unbelievable force of compounding at work. You can see it on this timeline. For decades, it starts slowly. It feels like you're just building a little bit of momentum. But then that curve starts to bend up. And in the later years, the growth just goes vertical. It's a snowball rolling down a very, very long hill. So the question is, how do you let that snowball keep rolling and get massive? The answer is you don't interrupt it. Selling a great business just to lock in a small gain is like pulling a plant out of the ground every week to check on its roots. You've got to let it be. Holding on to wonderful companies is what lets that compounding machine do its incredible thing. All right, this is probably his most famous piece of advice ever. And it's not just a clever little saying. It's a direct instruction manual for how to behave when emotions are running wild in the market. You have to learn to be a rational contrarian. Okay, it's a great line. We've all heard it. But what does that really mean? What does it actually look like in practice? When the world feels like it's falling apart, or when everyone you know is getting swept up in some crazy bubble? Well, here's what it looks like. It means having your cash ready and your homework done so that when the market inevitably panics, you don't see a disaster. You see the sale you've been patiently waiting for. That's the moment when those wonderful businesses finally get marked down. And that brings us to our final pillar, one that often gets overlooked but is arguably the most important of all. It's not about spreadsheets, it's not about financial models. It's about people. It's about character and the very human side of doing business. This is Buffett's bedrock belief. It's so simple but so true. At the end of the day, when you invest in a company, what you're really doing is placing your trust in the people who run it. And if their character is flawed, it doesn't matter how great the business model is, that flaw will eventually poison everything. So when he looks at leadership, his filter is famously simple. He's looking for three things. First, intelligence, of course. Second, energy, a real passion for the business. But it's that third trait, integrity, that outweighs the other two combined. And he makes it crystal clear. The first two without the third are totally worthless. In fact, he says an intelligent, energetic person without integrity is actually incredibly dangerous. Integrity is the one thing you absolutely cannot compromise on. It's non-negotiable. And this idea connects directly to the value of the business itself. A company's reputation is one of its most valuable assets, and it's built slowly over decades of good decisions. But just like a personal reputation, it can all be destroyed in an instant by one foolish act. Principled habits are what protect that value. So, to wrap this all up, his entire philosophy can really be captured in this one beautiful metaphor. Investing well isn't about trying to harvest some fruit tomorrow. It's about having the foresight and the patience to plant a sapling today, knowing that you, or maybe someone else, will get to benefit from its shade many, many years from now. When you strip it all away, the Buffett style of investing isn't some secret formula. It's a framework for rational thinking, for emotional discipline, and for having a true long-term perspective. And it leaves all of us with a pretty simple but profound question to think about in our own lives. What tree will you plant?